Hey everyone, Chris Hobart here, and I want to welcome you to the Hobart Weekly. Now, this is a series we created to take important financial topics, market updates, planning issues, as well as economic headlines, and just put them into plain English. Now, whether we're talking about retirement income or taxes or investments or business planning or maybe family wealth, we've always got the same goal to make thoughtful decisions with better information and a clearer perspective. So, this week, I want to spend a few minutes on Social Security. Every once in a while, headlines come across that make people stop and say, wait a minute, do I need to be worried about this? And Social Security, it tends to be one of those big topics. Maybe you saw a headline recently that said a phrase like, there's trust fund depletion or insolvency or benefit cuts. That naturally gets attention, and it should. Our phone at the office tends to ring a little bit more because Social Security is a meaningful part of the retirement picture for millions of Americans. Even for families who have built significant investment portfolios and pensions and have businesses and other sources of income, Social Security, it still matters. But it's also important to separate concern from panic. So today, I want to walk through the latest Social Security Trustees report that came out a few weeks back, and then explain what the numbers are really telling us, why they matter, and then how do we think about them in the context of a broader financial plan. All right, to understand Social Security, we got to go all the way back to 1935, and that's when Franklin D. Roosevelt had the New Deal, and that's when Social Security was created. Now, originally, it was designed to provide income for retired workers that were 65 and older. Now, over time, that program has expanded to include survivor benefits, disability benefits, as well as supplemental security income. Now, today, when we talk about Social Security's financial health, primarily we're talking about two trust funds. One is called the Old Age and Survivors Insurance Trust Fund, which is known as the OASI. And then there's the Disability Insurance Trust Fund, which is known as DI. Now, together, they're oftentimes referred to as OASDI. Now, I want you to think of these trust funds as reserve accounts. Now, for many years, Social Security collected more in dedicated revenue than it paid out in benefits. Hooray, right? Now, these surpluses built up reserves, and according to the report, those reserves, they peaked at about $2.9 trillion back in 2020. Now, since then, the picture's changed quite a bit. The trustees now project that the Retirement Trust Fund itself, the OASI fund, it could be depleted by 2032. Now, if you combine that with the Disability Trust Fund, the overall Social Security trust funds are projected to be depleted by 2034. Now, I get it, depleted. That sounds dramatic. So I want to be very clear about what it does and does not mean. It doesn't mean that Social Security disappears, and it doesn't mean that there's no money coming in. But it does mean that if there are no changes, the trust fund reserves would be exhausted, and Social Security would then rely mainly on incoming payroll tax revenue alone. And at that point, the report estimates that incoming revenue is going to cover about 83% of scheduled benefits. So plain English, that means there's a projected funding gap. Not a complete collapse, but there's a gap that's got to be addressed. And I think that's the important distinction. Let's think about it from a household perspective, right? Let's imagine there's a family that has income coming in every month, but expenses creep and they're growing faster than the income. And for a while, they dip into their savings to make up the difference. But once the savings are gone, they either need more income, they got to lower their expenses, and likely a combination of both, right? And that is essentially the challenge that Social Security is facing right now. Now, the report, it also points out that restoring long-term solvency, it's going to require some really difficult choices. The trustees estimate that maintaining solvency over the next 75 years would require either a 25% reduction in total benefits, a 34% increase in the Social Security payroll tax rate, or some combination of those changes together, which is probably likely. Now, those are big numbers. And they're also a reminder that there's not going to be a painless solution to this. Now, one of the main reasons this issue exists, it's all about demographics. Let's go back to 1945, right? There were about 41.9 covered workers, or what we'd call a worker, for every Social Security beneficiary, 1 to 41.9. By 1955, that number had fallen to 8.6 workers for every one. Now, by 1965, it was 4 workers for every 1. And for several decades after that, the ratio had generally stayed in the range of about 3 to 3.5 workers per beneficiary. Now, recently, that ratio, it's continued to decline. In 2005, there were about 3.3 workers per beneficiary. Now, by 2025, that had fallen to 2.6 per beneficiary. Now, if we look further ahead, the trustees project that that number could be declined to about 1.9 per beneficiary by 2100. Now, that matters because Social Security is largely funded by current workers paying payroll taxes to support current beneficiaries. And when there are fewer workers supporting each beneficiary, that's just more pressure on the system. So this isn't just a math problem, it's also a planning issue. For someone already retired, these reports can feel a bit unsettling. For somebody approaching retirement, they may raise questions about when to claim benefits. And for someone still building wealth, well, it's a reminder that Social Security should be part of the plan, but likely not all of the plan. Now, one thing I want to caution against is making a rushed claiming decision just based upon these headlines. Sometimes people, they hear about Social Security funding issues and they think, geez, maybe I should claim as early as possible before something changes. But claiming Social Security, it's a bit more personal than that. It depends on your income needs, your health, your spouse benefits, your taxes, longevity, investment accounts, and the role Social Security plays in your overall retirement income strategy. So a lot of moving parts. Now, for a lot of successful families, Social Security, it may not be the largest asset in the plan, but it still helps connect to several important decisions. How much you withdraw from investment accounts, how you manage your taxable income, whether Roth conversions make sense, how Medicare premiums may be affected, as well as how you create dependable income in retirement. So I think the bigger lesson here, it's not to panic over the word insolvency, but the bigger lesson is to plan and have flexibility in that planning. The thing is, we don't know exactly what Congress is going to do. Change could include tax increases. They could change the benefit formula, adjustments to full retirement age, changes for higher earners, or possibly a combination of all of those. But we do know that the math will likely need to be addressed. So the best approach is to build a plan that does not depend on one single assumption being perfect. Social Security, it matters. The trust fund projections, they matter. The worker to beneficiary ratio matters, but they're all pieces of a much larger retirement picture. And the goal is to understand the numbers, keep the right perspective, and make thoughtful decisions based upon your real life, not just the latest headlines. So if you've got some specific questions about how these Social Security updates might affect your retirement income, your tax picture, or your broader financial plan, obviously one of our team members at Hobart Wealth are here to serve you, and we'd be happy to provide some more data and information for you and your accounts. As always, the goal is to stay informed, stay thoughtful, and continue making financial decisions with the long term in mind. Until next time.